At some point in every cycle, retail panic meets institutional strategy, and that moment is staring us in the face as we speak. The major players are covertly increasing their bets as the ordinary investor is selling their positions due to anxiety. Throughout history, we have seen institutions purchase at the bottom when regular investors sell. Finally, retail makes a triumphant return, but it is far too late. Stocks, Bitcoin, and yes, even XRP are all experiencing this same dynamic right now. Your money is not being advised by this. Keep an eye on what's going on. In 2 consecutive weekly sales, retail investors have sold roughly $1 billion worth of equities in cryptocurrency, after nearly 9 months of regular purchases, that is. What occurred in that exact same week, though? This was the longest run of purchases by institutions since the bear market of 2022, totaling $1.1 billion. Give that some thought. After a minor bounce, regular investors are removing their bets, while the smart money is subtly preparing for what's to come, a deluge of fresh funds. Most individuals fail to notice it at this point. Why? Because they aren't looking at the money supply in M2. Liquidity cycles are not being considered. The Fed's plan is going unnoticed. Rather, they are behaving emotionally and cashing out too soon, a pattern we have witnessed time and time again. However, an additional 18 months have been added to the money supply. Budget cuts are on the way. There will soon be liquidity. It is well known by the institutions. While retail falls by the wayside, they are moving in ahead of schedule. Now, before we continue, allow me to say this fast. You need access to relevant information and resources if you wish to position yourself similarly to how institutions do it. For that reason, I compiled Find 100X Stocks, the Ultimate Millionaire Investor Guide. It lays out the specifics of spotting asymmetric chances ahead of the curve and is jam-packed with documents, photos, videos, and more. In the space below the video's comments, I've attached it. Be sure not to miss it. Have a look. We return to the data. It becomes glaringly obvious why selling now is the worst possible decision most people could make when you step back and examine the larger picture. Reason being, the Federal Reserve has historically achieved nothing less than meteoric success whenever it has reversed course, lowering interest rates and loosening monetary policy. Rewind to November, when the Federal Reserve made its initial move. By January, the markets had pushed themselves to new records. That was deliberate. That was the operation of liquidity, and it's occurring once more. Do you really want to side with retail traders who are driven by fear? Or would you rather side with the multi-billion-dollar institutions that are stocking up while the iron is hot? The decision you make now may have long-term consequences for your financial situation. One of the most outspoken people calling attention to this particular arrangement is Cathie Wood. She states that Bitcoin is a scarcity asset that occurs once in a generation. A novel asset class, cutting-edge technology, and a hedging all come together in an unprecedented way. Bitcoin's return to $30,000 or $40,000 is not something she's mentioning. She anticipates a 5-year total of $1.5 million. 3 drivers are laid out by her: possible alternatives to gold, widespread acceptance by institutions, and high demand in developing economies where people are frightened of losing their wealth to inflation and government takeovers. Plus, she has company. Check out how large pension funds, and asset managers are behaving. Bitcoin was considered a far-fetched concept, so they disregarded it for decades. But at this point, it's hard to turn a blind eye. Stock market indexes are now operational. Holding solutions are reaching maturity. Custom rails are currently under construction. Bitcoin and other cryptocurrencies are now using the same infrastructure that made gold popular. The dynamics of supply and demand will become chaotic if institutions release the floodgates. The reason being that there are strict limitations on the supply, unlike conventional currencies. There can be no more than 21 million Bitcoins in circulation. Nearly 20 million have been mined thus far. In a time when everything else is being devalued, the mere fact of scarcity attracts capital. When you consider that other economic factors such as labor are becoming less scarce due to AI and automation, the market's desire for the few assets that retain their scarcity becomes clear. On top of that list is Bitcoin. The element that the majority of people fail to understand is this: Bitcoin is more than just a digital currency. This asset can be seen as both risk-off and risk-on. Its value rises and falls in tandem with fear, much like gold. As a component of the emerging monetary system, it also goes hand in hand with technological products. Because of its dual nature, it stands out from everything else on the market today. At every news spike during the 2015 Greek crisis, when speculation about leaving the EU was at an all-time high, Bitcoin's value rose. Now let us go ahead to the regional banking crisis in the US. When faith in established authorities wavered, it once again provided a haven. Simultaneously, it functions as a tech bet, capitalizing on growth cycles, innovations, and investments in digital assets. So that's why Wood thinks it's a huge concept. That is why organizations are taking notice. This is precisely why they are receiving what they desire, cheap supply at the moment, thanks to retail panic selling. At the same time, we must not overlook the events unfolding in other parts of the market. The recent precipitous decline in oil prices is comparable to the largest hidden tax cut for households in recent memory. Reduced energy prices have a multiplier effect on the economy as a whole, reducing inflationary pressures and creating an ideal environment for risk assets. Although it's really significant, very few people seem to be paying attention to it. It all revolves on the US currency as well. Look at the big picture, and it's still holding strong historically, even though it has been weaker in the past several weeks. The United States' return on capital will skyrocket in comparison to the rest of the globe if deregulation, tax cuts, and tariff reductions come to fruition. And that's a positive dollar amount. Those Reagan years come to mind. Back then, the dollar got so strong that the international community had to work together through the Plaza Accord to bring it down. I didn't show weakness there. Then there was domination. It is entirely possible that we are preparing for a similar cycle. Now, for the exciting part, there are tight corners that the Fed must fight. More aggressively than ever before, they have already reduced the money supply. However, rate reduction are inescapable because to slowing GDP, mounting pressure, and a heated political cycle, this bodes well for the imminent arrival of liquidity injections. Fuel is liquidity, and that is precisely what has driven every single significant market upswing in the last 100 years. The game is being played out in front of your eyes as retail sellers unload their holdings following a modest uptick and institutions buy up everything. After all these years, it's still the same game. Now, the only thing to decide is whose side will you support. Now we may return to our original topic. There is going to be a flood of money into Bitcoin, XRP, gold, and even stocks. There is a flutter of lights. A lot of institutions are on the move, and retail is once again at odds with historical trends. After removing the distractions, what we observe today is a confluence of events that has the potential to change the course of not only Bitcoin, but the whole cryptocurrency and stock market complex, for the simple reason that these marketplaces are more linked than ever before. Liquidity supports the S&P 500 and will drive Bitcoin to new heights in the future. Additionally, formerly reticent institutional capital is starting to pour heavily into digital assets. This time, there's a structural difference. Before this cycle, Bitcoin's price movement was mostly due to speculation. The forces behind the market's unpredictability were a small number of risk-taking funds, pockets of very wealthy individuals, and individual retail traders. However, Bitcoin is now listed on the balance statements of publicly traded corporations. Your exchange-traded funds, ETFs, are now trading on key exchanges. Allocations are being investigated by sovereign wealth funds. No, that is not conjecture. Systemic integration is what that is. Institutional buying is quite powerful right now because of this integration. Bitcoin is not seen as a gamble by them. For some, it is a key holding, while for others, it is a required hedge. From the beginning, that mentality was totally different. Also, when big organizations make a commitment, they don't mince words. They don't average out hundreds of dollars in a single transaction. With billions of them, they move. Consider this for a moment. The mathematical timeline for the issuance of Bitcoin supply is decreasing. New supply is reduced every 4 years due to halving, which occurs at the same time as adoption is increasing. It will be years before the next halving occurs. It's approaching quickly. The similar pattern has been observed in every previous cycle. Massive repricing results from a combination of a tight supply market and a sudden increase in sales. The scale of that repricing could surpass all prior cycles, thanks to unprecedented institutional involvement. Now, though, let's take a step back and look at the bigger picture outside of Bitcoin. For the same reason that the events surrounding XRP, Ethereum, and other leading assets are of equal importance. XRP stands apart from Bitcoin due to its special function as a medium of exchange for international payments. For all its worldwide digital gold, Bitcoin is infrastructure, and XRP is a tool for settlement, liquidity, and speed. It will be more than just speculation if financial institutions, banks, and payment processors keep using XRP. The basis for valuing will be actual usage-based flows. In contrast, Ethereum is now fundamental to the decentralized financial system. Protocols have locked up billions of dollars worth of value, applications are growing in size, and Layer 2 solutions are reducing prices and increasing capacity. A maturing ecology is indicated by all indications. Institutions are keeping a careful eye on the situation this time as well. Their view of Ethereum extends beyond that of a simple currency to that of a digital economy, a network that creates value via fees, cash flows, and other means. That is the reason behind the influx of developers into the Ethereum ecosystem, the development of ETH products by asset managers, and the base case for Ethereum's continued strength despite volatility. I don't see any connection between any of these. Limitation and acceptance. Bitcoin is intrinsically limited. Ethereum functions as a platform with network effects and practical applications. XRP is well aligned with institutions. They are a new kind of asset that are dependent not on income or profits, but on technology, usage, and demand all over the world. For that reason, monetary policy, liquidity, and rate decreases are crucial. Reason being, risk assets do very well when the cost of capital decreases. Stock prices soar. Valuations of cryptocurrencies skyrocket. There is a bid for gold. Everything boils down to one central idea: money has to disappear. Financial institutions cannot sit on trillions of dollars and do nothing. By design, they are compelled to pursue profits. And in a world when debt is piling up, growth is sluggish, and fiat currencies are being weakened, the assets that are scarce and widely used stand out the most. Because this explains a lot of the present difference, let's go into the psychology of retail flows compared to institutional flows now. People shop based on their emotions. When they see bullish headlines, solid charts, and their buddies boasting about gains, they purchase. In times of market retracement, widespread anxiety, or growing doubt, they sell. It responds. That's just temporary. Survival is the driving force behind everything. In comparison, institutions function according to placement. They stock up when they're scared, ride the liquidity cycles, and spread their bets among assets with asymmetrical upside potential. They have years, not weeks, to plan ahead. They are more concerned with capitalizing on the overall trend than they are with day-to-day fluctuations. At this very moment, that is precisely what is happening. Retail, selling in a frenzy following a brief upswing, institutions buying without rest, no less than 6 weeks in a row, the longest run since the previous market downturn. Retail sales aren't the issue. Rather, it's that they happen at inconvenient times every time. And failing to grasp cycles is the key. Every time the money supply is increased, the market goes up. The delay can be anticipated. There is no denying the flow. The retail sector continues to fail miserably in this regard. Then what comes next? Interest rate decreases, inject liquidity, markets start pricing in the pivot, and asset prices rise. Retail investors who sold early will have to buy back in at greater prices when that increase speeds up. Additional benefits result from that purchase. The early adopters, on the other hand, ride the wave with little difficulty. This plays out in the same predictable way year after year, in the same economic cycles, and in the same parts of the world. We may return to the topic of macro developments now. The significance of crypto is growing due to developments in geopolitical factors as well as monetary policy. People and companies seek out alternatives when governments tighten capital barriers, inflation erodes purchasing power, and monetary levers are abused. Bitcoin is an option like that. That alternative payment option may be XRP. When it comes to digital infrastructure, Ethereum might be that substitute. The story here is national in scope, all throughout the world. Consider developing economies. Bitcoin isn't a speculative transaction in countries where inflation is rampant, currencies collapse overnight, and wealth can be taken with a pen stroke. Being alive is the goal. It serves as a form of insurance. One easy reason is why that insurance policy is becoming more popular: connectivity to the internet. You can join in if you have a phone. That one-size-fits-all quality changes everything. There are holes in the system everywhere, even in industrialized nations. The amount of debt is not manageable. There is a strain on fiscal policies. We have encircled central banks, Plus, every time they attempt to tighten, they run the danger of disrupting the system in some way. It happened with local banks. The UK pension problem is an example of this. It'll be back. Rather of weakening, the case for Bitcoin becomes stronger with each break. Now let's shift our focus back to commodities. Just like oil and gold, they tell us something. A covert stimulus, the fall in oil prices reduces pressures everywhere. Growth and consumption are both boosted by that. The holding of gold as a store of value is ongoing. However, the mathematically fixed quantity of Bitcoin much outweighs even the scarcity of gold. This process of mining for gold is not yet impossible. Bitcoin does not have the ability to do this. This distinction is significant. This is particularly true for organizations that use scarcity as a valuation mechanism. Even though it has taken a little tumble recently, the US dollar is still king. But as we can see from the past, power often brings its own share of difficulties. The impact of export demands, difficulties with global liquidity, collaborative efforts, rising demand for U.S. assets and the currency are possible outcomes of domestic deregulation and tax cuts that increase capital returns. This dynamic further supports the optimistic outlook for dollar-denominated risk assets. It's a circuit. Additionally, it is currently pointed in a single direction, more elevated. As a result, there is a perfect alignment of large-scale institutions. The retail industry is afraid to sell. Soon, the Federal Reserve will inject liquidity. Assets driven by scarcity poised for explosive growth. Rising demand for cryptocurrency due to geopolitical unpredictability. Emerging commodity patterns provide covert backing for expansion. Well, it isn't hype, there you have it. A situation that is disturbingly reminiscent to the times just preceding previous big breakouts. Additionally, the rarity of this alignment will become clear upon closer examination. In most cases, none of these elements will align simultaneously. Fragmented signals are the norm. Sure, some people are bullish, a few pessimists. Things are coming together, though, at the moment. It is well known by the institutions. They are not hesitating because of that. Their buying streak remains unbroken because of this. The retail sector is once again at danger of falling behind because of this. Realizing the true force of liquidity cycles is crucial to comprehending this moment. They aren't haphazard. These concepts are concrete. The financial markets cannot function without them. Liquidity increases the value of risk assets. Markets falter when liquidity decreases. We are currently entering a new expansionary period, following the most severe recession in decades. None of that is conjecture. The answer is numbers. Additional funds are constantly entering the system as a result of monetary policy actions such as interest rate cuts, liquidity injections, and fiscal measures aimed at stimulating growth. That cash isn't sitting around doing nothing. Returns are its goal. Crypto, rare commodities, and high-growth stocks, assets that offer the most direct route to asymmetric returns, also get the most boost. Unfortunately, retailers still aren't implementing this strategy. They read in the news that inflation is falling. A couple percentage points of chart bouncing is what they see. As a result, they act hastily to sell, assuming the relocation is complete. However, the delayed impacts are visible to institutions. They are aware that the market impact of liquidity movements takes several months. When retail gives up, they realize that's when you'll see the highest returns. That is why they are making their purchases at this time, because retail is cashing out and fear is reigning supreme. Recall the previous cycle. The market crashed at the end of 2018. Common people who had invested money ran away. Silently, institutions took their places. The Federal Reserve's 2019 policy shift caused risk assets to soar. Early sellers lost out on the comeback. In 2020, something similar occurred. Sales fueled by fear of a pandemic. Institutions buying. Massive injections of cash into the market, among the quickest rallies ever recorded. Nothing changes in the playbook, everyone else doesn't. Also, this time around, the participants are bigger, better coordinated, and more focused than before. Here we are discussing international investment firms that oversee trillions of dollars, pension funds seeking long-term hedging, funds owned by sovereign entities are branching out from fiat currency. These are not bargain hunters. It only takes one allocation shift from these whales to turn the market around. This is the perfect opportunity to hone in on the psychological warfare at work. Volatility is a boon for institutions. Fear is what fuels them. For their purchasing needs, they rely on retail sales. In order to establish positions without driving prices too high, they require weak hands to shake out, and every single headline about disaster each dip on the graph. With every sell-off prompted by fear, it's an element of the wealth transfer from hasty to patient people. The transfer is taking place in real time at the moment, selling billions of dollars in retail. Major financial institutions are investing billions. Here we go again. Except this time, it's not limited to stocks. Things go beyond connections. Crypto as well. That is the most significant distinction. Bitcoin and other cryptocurrencies are intrinsically scarce, unlike more conventional assets. With a maximum quantity of 21 million Bitcoins, financial institutions can't buy everything they want anytime they want. They need to compete if they want to be seen. What is available must be purchased. Furthermore, explosive upside occurs when demand increases at scale while supply remains constant. The network effects of Ethereum will only make this worse. With each new application, Layer 2 scaling solution, and wave of adoption, the Ethereum ecosystem becomes more attractive. Many institutions view ETH as more than just a token. They saw it as a way to gain exposure to a global decentralized economy similar to equity. How capital flows in alters depending on that perspective. Then there's XRP, which is in its own special place. All three of these facets of cross-border settlement, speed, liquidity provision, and financial infrastructure, are interdependent. The continued acceptance of XRP will transform it from a speculative trade into a tool integrated into the international monetary system. Because of how uncommon it is, institutions recognize that kind of positioning. And now we may add the international scene. Even while inflation is falling in the US, there is widespread instability on a worldwide scale. Demand for scarce neutral assets is driven by events such as currency devaluations, debt crises, and political shocks. Bitcoin has no bias. By definition, Ethereum does not take a side. If XRP gains traction, it can also serve that purpose. There is no discussion about this in emerging markets. This is the truth. In this day and age, people are utilizing Bitcoin as a hedge against monetary inflation, capital controls, and excessive government intervention. That tendency is only going to quicken. There are astounding similarities to the acceptance of gold. Before monetary systems failed, gold was written off as a relic for ages. Then all of a sudden, it was essential. The digital rails and worldwide connectivity are accelerating Bitcoin's progress along the same trend. Plus, you can't discount the influence of technology. The scarcity of both workers and goods is being alleviated by the rise of AI, robotics, and automation. Investors will demand a higher price for the few remaining scarce commodities as the globe moves toward abundance in some areas. Ethereum's network, the utility of XRP, and the scarcity of Bitcoin, these assets are well suited to take that premium. At the same time, oil and other commodities are subtly changing the macro backdrop. People and companies are essentially getting a huge tax break as a result of the precipitous decline in oil prices. Transportation and manufacturing are both impacted by falling energy prices, which in turn frees up capital and reduces inflationary pressures. Institutions are setting themselves up for precisely this type of rally, and it will boost growth and risk assets. Next, we have the dollar. On a long-term trade-weighted basis, it is still very strong, although it has experienced some short-term deterioration. Demand for dollars will increase if U.S. returns are amplified by deregulation and tax cuts. Continents' capital flocks to strong dollars. Somewhere, that money needs to go. Furthermore, when U.S. equities approach all-time highs and bonds lose their allure, scarce assets such as Bitcoin, Ethereum, and XRP become highly sought after. Not only is this alignment unprecedented, but it has also brought about cash injections, institutional acceptance, scarcity dynamics, global instability, and commodities relief. This arrangement occurs once every few generations. It is well known by the institutions. They are not hesitating because of that. For that reason, they are making purchases during retail sales. For that reason, they are making plans for a future that the average investor has no idea about just yet. Summing up is easy. Here we go again. Market liquidity is key, rareness triumphs, and establishments prepare ahead of time. At the moment, the signals are flashing a very bright green if you're paying close attention. Lastly, I will leave you with this. To avoid being caught in the wrong side of these cycles, like the majority of retail investors, you need to be able to spot asymmetric opportunities before everyone else. For that reason, I compiled the 100 times Stocks Ultimate Millionaire Investor Guide. You'll find a plethora of resources, documents, photographs, films, and more in the pinned comment section below this video that aim to help you think like the institutions do. Finally, for all you extremely serious folks, here's a bonus. Make a $1 deposit using my Robinhood link and get free NVDA stocks worth up to $200. You can find that in the description. Keep yourself well informed and alert, and I will see you in the next one.